I remember just for some reason, I think I saw the price of Bitcoin again, and I was like, "Whoa, this thing just went 10x um, in just a few years." And so I'm like, I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Like most people, I think, tend to think if something's gone up a lot, it's a bubble. But actually, in the equity world, a lot of times it's actually telling you something's real.
Particularly when it's a network. That's the big difference.
Yes.
Networks tend to do this um, much more consistently.
Correct. So with our not great understanding, we did spend about 4 months doing a research white paper on Bitcoin. It's exactly what you said. First, we found that if you just did a very simple two-factor model, which is the number of wallets and then activity per wallet, it explained over 90% of the rise of Bitcoin since inception.
Yeah, and it also is a good approximation for Metcalfe's law. It's the best way I got of fitting Metcalfe's law to the network value.
That's right. And then, we realized that's exactly why social media networks created value. Because, I mean, the idea of like eyeballs and someone being the customer and then because it's free and you sell them out, like that was a very new concept. So to me, I had already believed in this idea that you could create businesses digitally that didn't start with a factory. And so we published our first report on Bitcoin. It was around $1,000 though. But we said that by using the same two-factor model by 2022, it could be $25,000. And that was either saying it was going to be worth 10% of gold or the number of wallets were going to increase. I don't remember the whatever assumptions we used. And then when we published at the time, I did it more as like a thought piece. And of course, I was advocating for Bitcoin. We recommended 2%, but it wasn't something that we thought we would hang our reputation on. But it created immediate backlash for us with our institutional client, who became very angry that we were trying to pitch something that had no tangible value and was clearly just used for buying drugs. So we actually got famously fired by several well-known hedge funds. And but then I assumed we were probably onto something because I figured if someone...
Yeah, that's right. When you see that reaction, it's probably right.
Yeah, because if someone hates it, they haven't done the work.
Yeah.
And so now it's almost 9 years later, 8 years later. And Bitcoin's obviously done really well. It's actually had cycles, and I mean, you've been involved for a long time too. I remember you told me you got involved like in 2014.
2013.
Yeah.
I wrote the first ever macro strategy piece on Bitcoin in 2013.
Wow. Whatever that was the report John Norman saw. And that
might have been,
right?
Might have been. All the hedge funds, everybody passed it around because it became this thing of like, so I onboarded everybody from Dan Tapiero to Mark Yusko to, I mean, you name it, all the macro people was all because of me. John Burbank, I mean, you name it.
I might say that might have been your report because I don't know why John Norman would have brought up Bitcoin unless it was spinning around his desk,
Maybe it was. So I know we've got a hard stop coming up. So I just want to cover where we are today. So what's your framework for understanding the year ahead, next year? Just give me your data dump of, what are you looking at? What's interesting for you? How the macro plays out or the markets play.
I mean, I think the story arcs are pretty bullish right now. I mean, from the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive because it's a path for U.S. deficit to normalize. And I think, indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us. That justify, investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. And, I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is a demographic story. Um, I can send you some charts later, but if we look at the number of people aged 30 to 50 in the US, that's actually been steadily rising since 2018, 20, sorry, since 2009. It actually went positive in 2016. And what I mean by that is the number of people age 30 to 50 matters in an economy because they're the ones that are driving both credit consumption, but also productivity, innovation. Yeah.
And investment. In the end, I think all of macro is just demographics. By the time, if you do enough work, go deep enough down the rabbit hole, the one monster factor of all is basically demographics.
And then there's a contrast because, as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the US tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullish. People who are going to call the top in data center demand have never really experienced industrial cycles, right? Because the cycles actually are going to extend until return on invested capital is well past negative. And I would be very surprised if we're already reaching that saturation now, because we know that any model today would have improved capabilities if you improved computing power or capacity. So we aren't even experiencing the negative side of that utility yet. So I think that it actually would still argue that you need to be investing more capital. And I know, like when you look at percentage of GDP, I mean, look at what happened with China when direct private investment, it got to 40% of GDP. And that lasted years before you had overcapacity in China. So I don't know how we're even at saturation today in AI, but that's just in broad strokes. So I agree with you. I think there's still a big runway ahead. Well, I think it's highlighting two trends. One is they didn't do CapEx, but they did R&D, which until recently was a P&L expense, not a capitalized expense. And so they're supplanting those dollars for capital dollars that become balance sheet assets. In a world of labor shortage, that means you have less OpEx because that's wages, but you'll have more balance sheet intensity because now you have a computer that you're operating. So I think in a world of labor shortage, balance sheet intensity will go up. So it makes sense that these companies are big spenders of CapEx now. But that does create another wave of innovation because cooling and power supply and uninterrupted power and all these become strategic advantages, which will create another wave of technology innovation. So I think that there's a lot of opportunity and waves of opportunity being created because of that change that you've just highlighted.
Yeah, I think you're right, because it's going to be a game of efficiencies because the cost of these models is going down fast, and the compute is going down, but therefore they can increase output. So it's just this tremendous race to get more efficient at every single component part of that flywheel, from energy to chips to compute.
Yes. And we've even seen it in the financial industry. The financial industry used to trade labor intensive, so had a lot of traders and people. And then they replaced all the traders with computers. But someone naively might have said, well, then financial companies' CapEx will go down because they already have computers trading for them. No, CapEx intensity and tech intensity of the banks has actually only gone up since then. So that arms race, without even AI, is consuming more dollars. And that's, of course, I think going to be the case with AI itself.
Putting your stock picking hat on, how do you pick through what is going to win in the next few years? Because, yeah, sure, we can, sure, Microsoft will do fine, et cetera, but how do we make money out of this? And it's not very clear yet with AI, outside of NVIDIA and a few other stocks, how to really make money out of this, out of robotics. A lot of these kind of exponential age technologies, pretty tricky because not much around. There's pretty slim pickings because there's been no IPO market for bloody forever.
I've got two simple analogies to share that I think we should be looking for in AI. So we just published a study looking at the wireless fiber boom and when the stocks peaked relative to capital spending. And many people, so let's say it was a 20-year CapEx cycle for fiber and wireless. The stocks relative to the broad market peaked 8 years into the cycle. So in other words, like halfway into the cycle, the market will suddenly say enough capital has flowed into the space that they're market performers. However, in that like now in retrospect, the 25-year look back, one industry in wireless pulled away from everything. Two did. It was the first one is the tower industry. It has produced better returns than handset chips, carriers, spectrum owners, the towers, and it's, as you know, it's a boring business that grows in a unit with demand. The second, of course, was Apple came along, but in 2007, so 13 years into the industry and after the industry's stocks all peaked, Apple came in and essentially gobbled up the economics of the ecosystem. So I think that in AI, it'll pay to look for the tower equivalent and the next iOS that'll come out on top of everything. But I think the second thing that's going to be important is that you just described it. AI is infinite workers with PhD qualifications.
Today. Don't forget, in 2 years' time.
Yeah, it'll be super intelligent, right?
Super intelligence. Something we've never had before.
Correct. And yet, these super intelligent entities have to eat pizza. And what I mean by that is like the best performing stock in the last 25 years is Domino's Pizza because everybody has to eat. So if you could find the pizza of the AI worker, so that's not the infrastructure, it's what you have to feed the worker, that's another moneymaker. And I don't know what that is going to be.
So I've got two thoughts on that. Obviously, one is the energy flywheel, right? If you're feeding AI, it's going to be probably something to do with the energy mix and how that's delivered and what. And I don't know, again, because the energy grid is going to get reconstructed and changed anyway. The other one that I've come up with is we are so digital now. We're going to become more digital. Our roles in whatever a workforce is or the economy is going to change. But tomorrow will be more digital than today. That is a fact. And that is not going to stop for the rest of our lifetimes. So it's going to cause an equal and opposite reaction. Somewhere within this, tangible experiences become premium experiences. And, you know, if you look at the rise of LVMH, there's something in that story which is equivalent to your pizza, but the luxury pizza. Somewhere within this is going to be an equal and opposite story that's going to be immensely valuable to us as humans.
The thing that is the most non-fungible, you know?
That's
like
right. That's exactly right.
Yeah. Yeah, that's a good point because you're right. We're going to be polluting and corroding so many human experiences, especially like with android robots and fake friendships and, you know, things that get really polluted.
Well, look, Tom, we do this now. We're so used to doing this on Zoom. Go back 10 years, you and I would have had to have met at an event or whatever.
Yeah.
And those experiences matter because they actually form true relationships and stuff. And you don't do it this way otherwise.
Yeah. In fact, I don't know if you know this. Someone did an experiment and you should just check this out. Whenever people shake hands, okay, and the research study this, you 100% of the time end up smelling your hands because you're trying to detect the
pheromones
of someone else, but you don't realize you're doing it. And they said that so it's still instinctual that we need to meet in person.
Yeah, because pheromone exchange is what we do, and we don't realize it because we see dogs do that and cats do that. We don't realize that we do.
Yeah,
but we do. Tom, I know you need to get out of here, but listen, fabulous conversation. I think there's a lot more we can talk about because we didn't really cover much of the future and where it's going. But I just think it's also very important to hear the past because people don't know why you make decisions that you make or why you have the understanding that you have until they understand where you came from. So thank you for sharing that as well. And I look forward to getting together again at some point soon.
Yeah, that'd be great. And probably in person next time, right?
Absolutely, my friend.
Okay.
Take care.
Take care.